I'll tell you why I stopped that.
Okay.
There's a reason behind it.
Really?
Yeah. I'll tell you when the show is over.
Okay.
But there's a reason behind it.
Yeah. Okay.
I know you was trying to figure out like, wow, what happened?
Yeah.
I'll tell you.
Okay.
I mean, it's a good thing.
It's a good cause?
Absolutely, for us.
So you just, it came in your spirit? Or
No, it's just
somebody said it?
facts.
Okay.
No capping.
Okay.
Yeah,
No cap.
no capping.
Okay.
Ladies and gentlemen, if you're coming on, I want you to hit that like button, hit that share button, tag Lolly Dolly everybody. You know, we're kicking it live at 12 p.m. for the Ramonepreston show. I know we're a few minutes ahead. And we want to make sure we can give everybody a chance to like, share, drop the name of the city that you're representing today. Wherever you at, I want you to drop the city in the comments, drop the state in the comments. I don't know, you might be in another country. You might be up there with Elon Musk and Mars. So drop in the comments what city, what area, what location you're representing. And while we have a few more minutes before 12, I want you to hit the like button, hit the share button, tag Lolly Dolly everybody, and let them know at 12 o'clock noon today, Prophet Ramonepreston and the Ramonepreston show is live right here in the beautiful Buckhead community of Atlanta. We have an amazing show, amazing topic of discussion, and we look forward to having some good engagement, some activities, some questions, some interaction with all of our tribe members. Shout out to every one of you on Facebook and YouTube. Those are the two platforms that we're streaming live from today. Our goal is to stream live on every video and audio platform that we possibly can. But for now, we're where we are, and we're excited about today. So please, ladies and gentlemen, hit that like button, hit that share button, tag Lolly Dolly everybody. Let them know Prophet Ramonepreston and the Ramonepreston show. We about to go live at 12 o'clock noon. Today is Friday, April the 2nd, 2021. We are in the second quarter of this calendar year. This has been an amazing year so far. And we just launched our new one-year business coaching program. And I think we've surpassed our initial goal, didn't we? We surpassed it.
Yeah, we did.
No cap.
No cap.
No cap. We surpassed our initial goal. So I'm excited about that. I'm excited for the people who are a part of the coaching program because I know it's going to change and transform their lives. One thing about me,
And they still coming.
I'll over promise, but I'm going to over deliver. So that's what I love about it. We have just a few more seconds before noon. Please hit that like button, hit that share button, and tag somebody and let them know Prophet Ramonepreston and the Ramonepreston show is live on this beautiful Good Friday. This is an extraordinary day. This is an even more extraordinary weekend because we're celebrating the death, the burial, and resurrection of our Lord and Savior Jesus Christ. And I think we can all say it without even having to think it through. We're so grateful and appreciative to the Lord. Okay, ladies and gentlemen, welcome to the Ramonepreston Show. I'm your host, Prophet Ramonepreston. As you know, every Monday through Friday, we come to you at 12 o'clock p.m. right here on these amazing platforms to give you the most important information with regard to biblical economics. And when I say biblical economics, I'm talking about financial literacy, entrepreneurship, business ownership, ministry leadership, investments, and family legacy wealth building. So if there's any area among those areas or aspects of biblical economics that you're interested in, then we use this show as a platform to educate you. That's what my goal is. That's what my assignment is, to educate you, to empower you, to inform you, to heighten your awareness on these things that are centered around biblical economics. And so I'm excited today because I want to take some time to talk about how to evaluate a business. If you're familiar with shows like The Profit on MSNBC, like Shark Tank, and other economic or business related shows, then you may have heard terms like valuating a business or how to calculate the net worth of a business organization. And so today we're ending this week with this discussion on how to evaluate a business. I have a 7-step process that I like to use, and I believe that this 7-step process can at least get you in the ecosystem of learning how to evaluate your own business. If you have a business, if you have some type of organizational enterprise, and you're just interested in figuring out what is the valuation of your business or your organizational enterprise, these 7 steps will help you figure out how to evaluate your business. Please keep in mind, everything that I teach on the Ramonepreston show every Monday through Friday at 12 p.m. Is coming right out of my personal playbook called the Blueprint Game Plan Program. I'll tell you more about our Blueprint Game Plan Program if you don't know enough about it at the end of the show. And I will also share with you some very important information about a new 1-year coaching program that we just launched for April, which is going to run into April of 2022. But today, we want to talk about how to evaluate a business. And I have a 7-step process to show you how to evaluate a business. So make sure you got a pen, a notepad, or some type of device so you can take notes. Which, by the way, if you have a question that you would like to ask, you can actually dial in and ask the question live. I'm going to put you on speakerphone from my personal cell phone, and I'm going to answer your question live. So feel free to call in, dial in, and ask your question. Otherwise, if you want to be discreet and you want to ask your question, just drop it in the comment section, and we'll make sure we pull that question, and we'll do our best to answer it. But if you like to dial in with your question, I want you to dial 678-922-1963 extension number 1. 678-922-1963 extension number 1. Again, if you have a question that you would like to ask, even if it's not about evaluating a business, it could be anything concerning financial literacy. It could be about ministry. It could be about prophetic ministry. It could be about church building, church planning. It could be about church leadership. It could be about just about anything that I'm engaged in on a daily basis. I'll be more than happy to answer your question, or to at least tell you that I don't have an answer to your question. Dial 678-922-1963 extension 1. You can look in the comments and you'll see that number if you missed the memo. All right, so how to evaluate a business, how to evaluate your business, no matter what type of business you have, no matter what type of entrepreneurial endeavors that you are engaging in, no matter what type of products and services that you're looking to package in the form of a business. At some point, it's going to be very important for you to know how to evaluate that business. And all next week, I'm really going to be leaning into a lot of different aspects on things that are connected to evaluating your business. So I want to give you a 7-step process for evaluating your business. But first, let me give you a clear working definition for what a business valuation is. What is a business valuation? Well, a business valuation, by definition, it describes the economic process that is used to estimate the financial or dollar value of a business. So simply put, a business valuation is the process that you're going to go through, which is these 7 steps, to figure out what is the dollar value of your business. What is your business actually worth? That's very, very important, because a lot of people, they have businesses, they got business ideas, and they never take into consideration the real value, current value of their business, or even the potential future value of their business. But that plays a very important role, especially if you are operating your business through the structure of a holding company, which is what I teach, which is what I recommend, which is what I emphasize to all of our blueprint game plan purchasers, to all of our coaching clients, and to all of our consulting clients across the board. I recommend that, and I teach that to all of the people. So let's get to the 7 steps of this valuation of a business. There are 7 steps to valuating your business. Again, if you got a question, dial 678-922-1963 extension 1. The first step to valuating your business is you must identify the market cap rate. I know some of this language might sound a little bougie and sophisticated, but again, it's information that you have to learn if you're going to be a legitimate CEO. If you're going to run a business, if you're going to take your business system to the next level, if you're going to have an organizational enterprise, if you want to be financially free through the vehicle of a business, through the vehicle of building wealth and investing and establishing a solid entrepreneurial foundation, these are things that at some point you're going to have to learn. So it's best to just figure it out now, especially from somebody who knew none of this when I first started. Keep in mind, I had to educate myself about all of the things that I teach you and have simplified through systems and processes and formulas. So the first step to evaluating your business is you must identify the market cap rate. You must identify the market cap rate. What do you mean by the market cap rate? Well, the market cap rate is actually the return on investment by percentage for your type of business. That's what the market cap rate is. So for every business, there's a market cap rate or a certain percentage that most experts will attach to that type of business based on the return of investment. So I'm gonna give you an easy example. In real estate, because my wife and I, our bread and butter is real estate, so this is definitely something that's very important. Every piece of real estate has attached to it a market cap rate. So depending on what market that piece of real estate in, that will determine what the cap rate, the market cap rate of that piece of real estate is. Why is that important? Because that's going to determine the value of that piece of real estate. It's easy for me to understand it with a piece of real estate because every piece of real estate is actually a business. So whether it's a single family residential property or whether it's a warehouse or a multifamily property, each piece of real estate is actually a business, all right? But it's very similar to any other business. So the hair and nail business, that's a certain market. So there may be a certain market cap rate attached to the hair and nail business. The transportation business, there may be a certain market cap rate attached to the transportation business. The landscaping, the tree trimming, the painting, the construction, all of these areas of businesses are markets. And all of those markets have certain cap rates. So in order for you, depending on what type of business you have, in order for you to begin the process of evaluating your business, you have to identify the market cap rate. Now, it doesn't mean you're going to build your whole valuation around the market cap rate, but what it means is that you're at least identifying with the return of investment or the return on the investment by percentage for that type of business. In other words, if you were to purchase a business in that market, or if someone was to purchase a business in that market, what would be the return on that investment? Whatever the return on that investment is, that would be considered the market cap rate. So if you have a landscaping business and you sell your business, your landscaping business, for $100,000, or if the typical landscaping business is sold for $100,000, and whoever purchases a typical landscaping business for $100,000 will net at least a 10% return on that landscaping business, which means within a 12-month period of purchasing that $100,000 landscaping business, the purchaser can actually make or net $10,000. That means the market cap rate for the landscaping business can actually be considered 10%. That's how you identify with the market cap rate. That's very, very important. It's extremely important in real estate, because you can't even purchase a piece of real estate, especially as an investor. But even as a flipper or a wholesaler, it's just good to know what the market cap rate is. So the first step to valuating a business is you must identify with the market cap rate. Now, guess what? You may be asking, how do I find out what the market cap rate is? Well, I'm gonna give you one easy way to do it. Google it. Google what is the market cap rate for the apparel business. What is the market cap rate for a jewelry store? What is the market cap rate for a restaurant? What is the market cap rate for a trucking business? What is the market cap rate for a piece of real estate in Buckhead? So if you Google it, you can find it out. But guess what? There are brokers who are professionals in purchasing and selling businesses. These are merger and acquisition specialists. They're just like real estate brokers. Most entrepreneurs and small business owners don't know about these type of people, because most entrepreneurs and small business owners don't generate enough revenue and don't build their businesses the right way in order to even get in the ecosystem or in the environment with these types of people. But when you're watching the news and you're on social media and you're seeing all of these reports about this company merged with that company and this company bought this company out, these purchases or these mergers and acquisitions are taking place on a professional, sophisticated level. But a lot of these major firms that are working with these companies, whether it's the purchaser or the seller, these major firms are going through the valuation process. So they're not the only ones that should be going through this valuation process. You and I as small business owners, you and I as entrepreneurs, you and I as nonprofit executives, we should have our fingers on the pulse of these types of professional, sophisticated formulas and systems, because that's going to help to determine what type of success you're going to have in what you're doing. So the first step in evaluating your business is you must identify the market cap rate. And the market cap rate is by percentage the return on investment. So that means if a certain business is operating in a certain market, if it's connected to a certain industry, you need to figure out if a business in that industry or in that market is sold, how much return on investment does the average person make when they purchase that business within a 12-month period. That will help you identify with the market cap rate. Step number 2, you must determine the earnings multiplier. It's called the EM. You must determine the earnings multiplier. I just love this because a lot of this stuff I be talking about, I know a lot of small business entrepreneurs and side hustlers and local grinders don't know about this terminology, but it just makes you feel good when you can understand some of this stuff. It makes you feel like, you know what, there's hope for me, because I was always one of those types of people too that, man, I just need to know this stuff. I wonder how they figure this stuff out. And I didn't have the money, I didn't have the life, I didn't have the structure around me to afford to go to some 4 to 6 year college. So guess what? I just grinded it out, educated myself, and figured it out. Step number 2 to evaluate a business is you must determine the earnings multiplier. So the earnings multiplier is short for EM. EM is the earnings multiplier. Now the earnings multiplier is a method that is used by multiplying whatever the earnings multiplier is by the number of your gross or your net earnings. So every market, okay, whether it's the trucking business, whether it's the landscaping business, whether it's the construction business, whether it's the real estate business, whether it's a tech business, whether it's a financial service business, whatever the type of business it is, that business is connected to a certain market. It's connected to a certain industry. And every industry, every market that these businesses are in, those industries and markets have what they call EMs, or earnings multiplier. Now, if you watch Shark Tank, you will hear them say a lot of times to the entrepreneurs, what is the earnings multiplier? In other words, they're trying to figure out, how did you come to that valuation? So when someone comes on Shark Tank and they say, I'm asking for $100,000 for 10% of my business. What they're saying is they're evaluating their business at $1 million. And then Mr. Wonderful or Damon John, they'll come back and say, okay, you want $100,000 for 10%, which means your business is worth $1 million. How did you get to $1 million valuation? Well, we netted $100,000 last year. Okay, so that means it's a 10 times multiplier. And then they will explain to them, in that market or in that industry, you can't multiply your earnings 10 times, because every industry or market has a certain earnings multiplier. So your business might be in an industry where it's a 2x multiplier, which means you can only multiply your earnings by 2 times. So that means if you're in an industry or a market where you your net earnings are, let's say, $50,000 after you pay your expenses. If you're in a 2 times market or industry, which means the earnings multiplier for that industry is times 2, that means you can only take $50,000 and multiply it by 2 to help determine what the value is when you're using an earnings multiplier, which means the value of your business will be $100,000. But if your business is in an industry where it could be multiplied by 10, the earnings multiplier is a 10x. That means if you're netting $50,000, your business can be worth $500,000. So the earnings multiplier is very, very important for you to determine. That's the second step to evaluate a business. Step number 1 is to what? Identify your market cap rate. Step number 2 is to determine your earnings multiplier. And again, if you don't know what the earnings multiplier is for the type of business you have, Google it. Or you can talk to your CPA. You may have a CPA who's a valuation specialist. I work with CPAs and tax strategists who specialize in taking these factors and evaluating a business to determine what that business can actually be worth if it is on the market to sell. This is, y'all, I'm telling y'all, next week I'm gonna talk a lot about this stuff, but this stuff is a game changer. Watch, I'm gonna walk through a lot of these principles with the people who are in our 1-year coaching program, and I'm gonna show them not just how to increase their income, because my goal is to bring a lot of our coaching clients for this 1-year program to 6 figures and beyond, but I also wanna show them how to multiply the value of their business by how they structure their business, holding company, and by how they build it out using these specific formulas and economic strategies. This is the game. This is the game. How y'all think Kanye West has a $6.6 billion net worth across all of his assets. He has professional, sophisticated firms that are doing this type of legwork for him. So that now he can go to the open market and say, my businesses are worth $7 billion. I just need somebody to give me $2 billion cash so I can do more work. See, this is how you get to the next level, y'all. And it ain't just in real estate, even though real estate is very, very, very simple to understand a lot of these things, even though the wording is different. So step one to evaluate your business is what? Identify the market cap rate. Step number two to evaluate your business is to determine the earnings multiplier. Step number three, to evaluate a business, you must establish the business's revenue. You must establish the business's revenue. What do you mean by establishing the business's revenue? Well, this is the total amount of sales, not profits. This is the total amount of sales that your business is generating. So in order for you to establish the business's revenue, you have to basically know every dollar that comes into your business. Even if you go back just the last 90 days, at least you can take the last 90 days of income or gross revenue that you've had come in, and you can multiply that by 4 to see what would your annual income be. Or that's a forward projection. You could go back to what in real estate we call the T12, the trailing 12. You can go back to the last 12 months to see what were your gross earnings for the last 12 months. And you want to look at what were your net earnings. Your gross earnings are based on all the money that you had coming in through your organization. This is why I encourage people and highly recommend people, you got to have some type of accounting system like QuickBooks. You got to track all your income and all your expenses. You have to track it on a daily, weekly, monthly, yearly basis, because you want to know what your business's revenue is. The gross revenue, that's before any expenses, and then the net revenue, that's after expenses. So number 3 is you must establish the business's revenue. This is a part of the process that you're going to have to go through to evaluate your business. Step number 4, you must calculate the business's assets. You must calculate the business's assets. See, even if you're just starting a business, I think you should take a critical approach to starting your business or to building your business through the lens of a business valuation. Because if you approach your business through the lens of a business valuation, you're going to see that, wow, I'm doing all this talking and all this work and my business ain't even worth nothing. My business ain't even worth $200. So a lot of people, like for example, there are a lot of people, they around here like losing their minds behind a business that ain't even worth $1,000. Or they keep putting money in a business that has no value. Maybe it's time to pivot and erase that off the board and start fresh. These are the things that you're not even going to focus on if you're not evaluating your business on a regular basis. So the 4th step in evaluating your business is you must calculate the business's assets. Now, calculating the business's assets means that this could be inventory that you have. It could be vehicles that your business owns. It could be equipment. It could be IP or intellectual property that your business owns. It could be real estate or other assets. Now, when you're calculating your business assets, it's going to be important for you to consider the after purchase value of your business and the replacement cost of the assets in your business. And when I say the after purchase value, what I mean is, let me give an example. Let's say if you buy a business in a plaza by a liquor store, and then the laws change in that city that make it difficult for your business to do business because that liquor store has been in that plaza longer than you. If you didn't factor in the after purchase value of that business, you might be buying a doozy. You might be buying a business that ain't worth nothing. Or if you're buying a business and you're buying it based on certain clientele that people have, but their clientele is not based on contracts that they have. These are just clients that they say they're going to keep. But what happens is when you buy the business, they don't want to work with you no more. So now you bought a business based on revenue from clients that don't want to be your clients. So this is why you have to calculate the business assets. If you have a business, you need to know what your business assets are. This is one of the reasons why if you have a holding company set up, your holding company is going to house certain properties. So if that's equipment, you're going to use that equipment through another company that's operating a business that needs that equipment. If you have intellectual property, your holding company may own that intellectual property and may license it to another company that you are operating through your holding company. So for example, I've written 2 books. I'm working on my 3rd book. I've written 2 books, right? But I have so much other published work. I have manuals. I have marriage manuals. I have minister manuals. I have, oh my God, I have policies and procedures for churches. I have manuals for all types of positions in church and business. These are things that I've just created and I've put together, right? All of that is intellectual property. So I can actually have my holding company own all of my publishing rights, all of my copyrights, and I can start a publishing company and use that publishing company to just license out certain information that I have to churches or to businesses or to groups that need the content or the copyright that I have. This is how you build your assets, but also how you start expanding your holding company. I hope y'all getting the game and understanding what I'm saying. So you have to calculate your business's assets. So that means your business needs to have some inventory, some vehicles, equipments, intellectual property, real estate, or other assets that actually have some value. If your company doesn't have any of this, you need to take that into consideration because it's going to help the value of your business. And this is why when your company is making money, you got to reinvest in your company by purchasing assets, things that are actually making your business money. All right? Step number 5, you must estimate the business's liabilities. So now you have to estimate the business's liabilities. Estimating the business's liabilities means that this could be all the debts, all the loans, all the accounts payable, or anything that affects the after purchase value and the replacement cost value of the assets and of your business. So calculating your business's assets and estimating your business's liabilities is very, very similar to what you're going to do in your personal finances on a balance sheet, okay? Now, if you're using a system, an accounting system like QuickBooks should help you balance your assets versus your liabilities. Because when you start your business, whatever assets your business has, whatever the dollar value is of those assets, you should have already, or you should put those values into QuickBooks. So every time you do a profit and loss statement, every time you pull up your balance sheet for your business, you're going to see what your assets are, what your liabilities are, what your cash is, what reserves you have, and you're able to see what type of revenue, gross and net, minus expenses, that you've had come through your business. Now, all of this sounds so sophisticated, but a lot of this you could be doing if you're using QuickBooks. Because I'm gonna be honest with you, I know it might hurt for you to hear this, but if you're a business owner, if you're a nonprofit organizational leader, and you ain't got something like QuickBooks in order, that you can just go on right now, log in, and click a couple buttons and get a detailed list of your gross revenue, your expenses, your net earnings, your assets, your liabilities, your accounts payable, your accounts receivable. If you can't see all that in a QuickBook type system, guess what? You ain't running no doggone business. You just got a good idea on paper, and it ain't even on paper, it's just in your mind, and you're running that good idea into the ground. You're not running a business, and I'm gonna be the one to tell you the truth. So here are the 7 steps to evaluating a business. We got a question? What's the question? Question from where? YouTube?
Okay. He said, would you have your holding company in the same state as your operating company? I am about to start a trucking company, one truck operation.
Yep. The question is, would you have your holding company in the same state of your operating company? I have to say it depends, but in most cases, yes. Here's why I say it depends. Because people who start holding companies in Wyoming, in Nevada, and in Delaware, they start holding companies in those states for the most part. This is not the only reason, but for the most part, they start these companies in these states because of certain legal language that they can use for protection in the event that they are sued, or in the event that lawyers come after them for some reason. A lot of times they start in these states holding companies because of anonymity, which means they don't want someone to go to their state's business search engine and find out who is the owner, who is the person that owns that business. Those are just some of the reasons why people start holding companies out of state. But that's why I said it depends. If you're just a person that you trying to protect yourself, you don't want nobody to know who you is, and you just think, it's going to be better, then start a holding company in another state. You're just going to have to start another operating company in the state you're doing business in, and you're going to have to make sure that you're starting it and the paperwork is correct. Because if you started and the paperwork is not correct, which means you haven't had a legal expert to do it the right way, well, whenever you're sued, they're going to find the loopholes that you don't know nothing about, and you're still going to be sued and be exposed. So that's why I said it depends. But typically, you're going to start your holding company in your state, and you're going to start your operating company in your state, especially when you ain't worrying about no anonymity. You're already protected through the companies. That's what a LLC is for. It's for limited liability protection. So you're going to start your holding company, and then your holding company is then you're going to start an operating company, and you're going to own the holding company, and your holding company is going to own your operating company. I would do it in the same state, because if you ain't trying to be bougie and sophisticated, which if you're doing it yourself, you probably don't know what you're doing, because you don't know how the laws change. I'm not even going to do that kind of stuff unless I'm using a lawyer or an expert who knows what they're doing. So if you're trying to do it yourself, you better start that doggone LLC in your state, that holding company, and then start your operating company in the state as well. That's what I would do. That's what most people do, because they're not looking for anonymity, and they understand if they have one company as a holding company that they own, and then that holding company owns another operating company. Let's say if your trucking company is owned by your holding company, if somebody sues your trucking company is the only company that's going to be liable. Your holding company is not going to be liable, because your trucking company has limited liability. That's why it's a LLC. So that means they sue your trucking company, but your holding company is not liable. So the only thing that they can get in the worst case scenario is what your trucking company owns. And if you're real savvy and sophisticated with it, your trucking company might not even own the truck. Your trucking company may license or lease the truck from your holding company or from another leasing company that you start. That's the game. Hope I answered that question. So where we at? Number 6? Step number 6. You must analyze the business's net earnings. So you want to analyze the business's net earnings. Remember, in step 3, you establish the business's revenue. That's you seeing what all revenue is that's coming in, all revenue streams, not profits, just all revenue. If you have a holding company and your holding company owns 4 or 5 operating companies, and your holding company has 6 or 7 divisions within it, then that could be 10 streams of income you got coming in to your holding company. So you want to establish your overall revenue for your holding company, but then in step 6, you want to analyze your business's net earnings. You want to analyze your business's net earnings. Now, analyzing your business's net earnings means that this method will be used by deducting your operating costs from your gross revenue. This is how you determine your net earnings. Now, in the business world, there's a term called EBITDA. It's EBITDA. It's earnings and earnings before interest, taxes, and amortization. So a lot of business experts, they use the EBITDA, some say EBITDA method to figure out what your earnings are before interest, taxes, depreciation, and amortization. That's what the EBITDA comes in at. But to simplify that, so that you won't get confused, to simplify that, analyzing your business's net earnings is you seeing what your gross revenue is minus your expenses. That's your net earnings. And again, that's kind of like the EBITDA method because it's before taxes. But that's going to be very important before taxes because there are a lot of decisions that you're going to make pre-tax. Some of those decisions that you make pre-tax are non-taxable events, and some of them are taxable events. But that's something that you're going to talk to your CPA or your tax strategist about before those decisions are made. But for the purpose of evaluating your business, you want to analyze your business's net earnings. That's the 6th step. All right? Step number 7 is you want to assess the liquidation value. You want to assess the liquidation value. And trust me on this. Trust me on this. A lot of what you hear me saying, depending on what type of person you are, a lot of what you hear me saying is boring. It really doesn't resonate. It don't make sense to you. But guess what? It's going to be the difference between you failing and succeeding at some point in your entrepreneurial endeavors. Especially if you are on our Blueprint Game Plan. Everything that I'm talking about right now, I have it in my Blueprint Game Plan program. There's a whole segment on valuating a business in there. And so that means you've got to familiarize yourself with this type of information, with these terms, with these concepts, with these principles, with these formulas, because this is going to help determine the success or the failure of your business. At some point it will. At some point it will. There is no way you should be building a business or developing some type of product and service and you don't understand certain terms. I'm just one of those people where I'm simplifying that process so that you can have something that's easier for you to swallow and digest, so it can be manageable within your brain. So the 7th step to evaluating a business is you must assess the liquidation value. What do you mean by assessing the liquidation value? This reflects what your business would be worth in dollars if it was liquidated, not acquired. This is another way of describing what we call the fair market value method. So assessing your liquidation value is basically figuring out, if I was to just liquidate my business. Have you ever passed by a plaza and you've seen liquidation sale? That's step 7. They have already assessed it. They already know what the fair market value is of that company based on the inventory, based on the assets, and they know if someone acquired that business, which means that they sold it through brokers, they could have made $5 million. But in order to liquidate it, they're going to make $1 million. So they've settled with the 1 million, which means they may have settled with their debtors, they may have settled with banks, they may have settled with investors for the 1 million, even though in a acquisition deal they could have made 5 million, but now they're liquidating it. That's going to be very important because you want to know what the worst case scenario is of your business. Guess what? There are a lot of people, if they knew this before the quarantine ended, they may have been in a position to sell their businesses before they lost them. A lot of people lost them because they just didn't know what to do, because they didn't have this type of data. At least if I got this type of data, I know what I can do. So again, those are the 7 steps, ladies and gentlemen, to evaluating a business. If you got any questions, I want you to dial 678-922-1963, 678-922-1963, extension number 1. I'll be more than happy to answer any of your questions. How to evaluate a business. I just gave you 7 steps to do that. Step 1 is identify your market cap rate. Step 2, determine your earnings multiplier. Step 3, establish your business's revenue. Step 4, calculate your business's assets. Step 5, estimate your business's liabilities. Step 6, analyze your business's net earnings. And step 7, assess your liquidation value. Those are the 7 steps that you can use to get a clear, and in most cases, a very accurate valuation of your business. I'm going to stop right there. Next week, I'm going to continue talking about some principles and some systems and formulas that are connected to this conversation. We have another question.
It says, what kind of stocks do you invest in?
I have never invested in a stock. I don't invest in stocks. I don't have a problem with people investing in stocks because, number one, that's their business. They do what they want to do with their money. For me, one of the reasons why I don't invest in stocks, and I've never invested in stocks, is because the return on the investments that I make are historically better than the returns on investments that I would have made had I taken the liquid cash that I had and invested it in the stock market. So let me give you an example. If I have $5,000 of free liquid cash sitting in a savings account that I don't have to spend, that I don't need, that I know I can allocate to invest, it is better for me to get a greater return on my investment of this $5,000 by putting that $5,000 either into my business because I know my business, or another business because I understand businesses, or in a piece of real estate which is actually a business. Any of those 3 areas is an investment for me, which is more lucrative than stocks. And guess what? Even though investing in the stock market can have a lower risk than it would be for me to invest at certain points in my business, another business, or a piece of real estate, which is actually a business, but the historical returns that I get, the historical returns that I know I can get, are much better than the returns that you get historically in the stock market. So even if historically you can invest in stocks and get a 10% return on your investment every year, of course, if you just keep reinvesting that 10% every year with your initial investment, the compound interest is going to move that money quicker. But there are investments that I have made in my business. There are investments I've made in other businesses. And when I say investing in other businesses, that means I can invest in ownership interests in another business, and I can invest in other businesses by loaning my money to business owners at a certain percentage, which means my return is going to be greater than the stock market. Or I can invest in a piece of real estate, and because my wife and I are in real estate, I can get a 30 or 40% return where I wouldn't have only got a 10% return. So I don't invest in the stock market.
Also, I have another question too.
Okay.
Because he said, so no indexes or IRAs. So no indexes or IRAs. So I guess you don't.
No indexes or IRAs. Now again, for me, I'm a little more familiar with, when it comes to stocks, I'm familiar with the return on more of the aggressive growth stocks, but they're more volatile too, which means there's a higher risk than some of the IRAs or index funds. But when it comes to stocks, honestly, I don't know enough about it, and I'm not even interested in it because I'm controlling the narrative of my money. I control the narrative of my investments, and my money is always closer to me or close enough to me that I'm able to move it at a faster speed than any stocks that I have heard about.
Also, too, he was, Ronald was like, would I do, he said.
I'm sorry, but now guess what? Let me say this last point.
Okay.
If you're not like me, if you're not a grinder and a go-getter and you don't know about ways to invest in your business to get a greater return on your money, if you don't know how to loan your money and get a return, or to invest in other businesses, to own shares in or stocks, shares, ownership interests in other businesses, if you don't know about real estate investing, then don't play that game. You need to find a fiduciary, someone who is an expert in stocks. That means you need to go like to Vanguard. Vanguard is a very well-known hedge fund or mutual fund. They're like a big company. Or you go to some type of investment advisor, somebody who knows what they're doing. You're not listening to somebody on YouTube. Don't listen to me, okay? Not when it comes to something I don't know nothing about. And don't listen to nobody who think they know what they do talking about and they don't even invest in the stock market. No, you go to a fiduciary. You go to somebody who's licensed, who can get your money. Otherwise, you're gonna be on American Greed crying. I gave him $18,000 and he skipped town. You should have went to somebody who was legit, who was licensed, who understood investment. So if you're not like an aggressive go-getter like me, and you